With the topic that is fiscal policy. First of all, let me give my introduction. This is Shalini Kachwani. I'm an MBA in the field of finance and marketing, and currently I'm preparing for Ugcnet management. So, fiscal policy is the most important policy which is given by the Ministry of Finance. It is a part of macroeconomics. Okay, fiscal policy is the part of macroeconomics. It is also known as budgetary policy, as well as sister of monetary policy. Both the policy, fiscal policy as well as monetary policy, are framed to stabilize the economy. The main object of this policy is to stabilize the economy of our country. What is meant by stabilizing? Stabilizing refers to there should be no inflation, there should be no deflation, there should be no rise in price, and there should be no decrease in the price of the product. There should be a stability in an economy. If there is inflation or deflation, both the condition are worse. Why? Because in one situation there is less money, in one situation there is huge number of money. So both the condition affects the growth of the economy. So the money should be in the balance. Okay, the government frames both the policies so that the money should be in regulation. It should not be in excess and it should not be in deficit in the market. Okay, so macroeconomic basically deals with the two policy. Okay, first of all, what is meant by macroeconomic is a branch of economics which is concerned with overall structure of an economy. Like if I'm talking about India, so we are going to see the structure of India. What is the political environment, social environment, legal environment, technological environment, demographic environment. Okay, what is the structure of economy? Then what is the behavior of the economy, how the economy is functioning, what is the scenario, what is the situation of the index, what is the situation or the percentage of GDP, GNP, per capita income, everything. Okay, macroeconomic is considered as a whole of the economy. It not considers or analyzes just an individual, but it analyzes overall economy. Okay, now macroeconomic concern with two policies basically. First is fiscal policy, which is regulated by the Ministry of Finance. Okay, Ministry of Finance. Whereas this policy is regulated by RBI, Reserve Bank of India, which is known as Central Bank of India. Both the policies are formulated to stabilize the economy of our country. And what are the main object of both the policy? Okay, let me give you a brief. What are the object, why this policy has been framed? First, most important point is mobilization of resources. The resources should be mobilized effectively from one place to another. Mobilization of resources. Employment generation of employability. Capital formation of capital. Development of infrastructure. Infrastructure should be developed. What are infrastructure? Infrastructure refers to the development of roads of country, bridges, education sector or education institute, medical facility, etc. Okay. Now, monetary policy is the policy given by Reserve Bank of India, and fiscal policy is the policy given by Ministry of Finance. Okay, so let me give you a brief regarding monetary policy. Monetary policy is also concerned with regulating the flow of money in the market. Okay, and it is concerned with basically to regulate the availability of funds, how much money should be They in the market. Monetary policy is concerned with that. Okay, regulate the flow of money in the market. And use of money. How much money we need to use. Okay. So basically, what are the object of this policy? It is also concerned with providing employability, price stability. Price should be stable. There should be no inflation, deflation. Economic growth. The economy should be growing. There should be an increase in GDP, GNP, per capita income. Very important. All these three sectors should be growing. Gross domestic product should be increasing. National income should be increasing. Per capita income should be increasing. And it is also concerned with BOP, balance of payment. The balance of payment should be balanced. It should not be deficit. Import should be not high. If we are importing more and we are exporting less, what will happen? We have to pay more in the other country's currency. What will happen? Our currency's value will be decreasing. That's why government says, do entrepreneurship, make a new business plan and export the product in the international market. What will happen? Export will be increasing and import will be decreasing, because we'll be becoming self-reliant, will be not dependent on other countries for the product. That's why government provides subsidy to the small scale industries, to the new entrepreneurs, to the business planners, because that promotes export and the value of a currency will increase. Now monetary policy is concerned with some things. I'm telling you, CRR, okay, somewhat instruments, we can say instruments of monetary policy, SLR, repo rate and reverse repo rate. CRR, cash reserve ratio, statutory liquidity ratio, repo rate, reverse repo rate. See, this topic, monetary policy, I am going to explain in the next class and the next PPT, but now I am going to just focus on fiscal policy in depth. So let's start. Fiscal policy. Fiscal policy is a vital part of the economy framework of a country. Okay, this plays a very important role in our economy. Fiscal policy. First of all, children, why policy is being framed? Why any country makes a policy? Framing of policy is concerned with eradicating some issues, some social issues, some economic issues. What are the issues any country faces? The issues like unemployment, the major issue, poverty, regional imbalance, okay, less capital formation, less GDP, less GNP. All these are the social issues that a country faces, or economic issues. So what is the most important thing for a country? Country needs to analyze what are the places where we are lacking. We need to analyze, we need to frame policy. Okay, problem of inflation, deflation, recession, all these conditions are very worse for an economy, because if a country is going on inflation, then also there will be a lot of issue. Why Greece? Why many countries have become insolvent? Because there was no policy for regulating the money or controlling the money in the market. That's why India frames two policy, monetary policy, fiscal policy, to regulate the flow of money in the market. How much money should be floated in the market? Should not be excess, should not be deficit. Okay, should be balanced, so that my economy grows. There is an increase of employability, capital formation. There should be no difference between income and wealth. There should be development of infrastructure, facilities to the consumer or the public living in that particular country. Fiscal policy is a vital part of the economic framework. Vital is concerned with important and is closely linked with the overall economy policy strategy. Tax policy, okay, how much tax need to be collected, what are the expenditure government will be doing, where government will be investing, okay, where government will be divestment. Divestment is basically conversion of public sector into private sector. When public sector public or government cannot handle that particular sector, then that sector is given to private entrepreneurs to handle it, to make it more productive, to grow, to give up profitability, because public sector basically we see in India is not being handled properly, whereas private entrepreneurs handle the sector very efficiently. Okay, that's divestment. Strategy: debt or surplus management. What are the debt? What are the surplus? If we are going in debt, if the country is going in debt, they have taken loan from different countries and they have to repay them with the interest. What will be the situation? How they're going to handle? If they have money, where they need to utilize that money, in which sector they need to utilize the money. Okay, like in India, India is a developing country. They need to utilize the resource, or they need to allocate the resource in the sector which will generate more employability, which will generate entrepreneurship or business plan. Okay, because there is a huge number of unemployed people, educated youth unemployed. Okay, fiscal policy is the policy of the government. It is a policy given by the government which particularly aims for nation's development. This policy is concerned with developing nation. How nation will be developed? Where there will be good jobs, where people will be contributing towards GDP, GNP, per capita income. There will be less poverty, there will be less regional imbalance, there will be development of infrastructure, medical facility, education facility, everything will be there. So that's a nation's development. Okay. Now fiscal policy is also known as budgetary policy. Okay, it has also named budgetary policy, and it is given by the government or Ministry of Finance, whereas monetary policy is given by Reserve Bank of India. That's a central bank. Just remember, people get confused between monetary policy and fiscal policy. Both are very different. Different in the sense both are given by different organization. Okay, but both are aimed at stabilizing the economy, eradicating unemployment, eradicating poverty, generating capital formation, generating investment. Okay. Now, it is also known as tax and expenditure policy also. It has other name also, that's tax and expenditure policy, because it is concerned with collection of taxes, that is termed as revenue of the government, where the government earns from direct tax, indirect tax, and expenditure, the spending of the government. Okay, where the government is spending their money which is collected through taxes. Spending in the infrastructure, education sector, medical facility, bridges, roads, power generation, industries, etc. Receipt and expenditure. Receipt is tax or the revenue from the people through taxes. Taxes are direct tax and indirect tax. Now there is an introduction of GST. One country, one tax. Okay. Now, fiscal policy is concerned with economy of, fiscal policy is concerned with effective use of state treasury. Treasury is concerned with money, the money government has, and the government finance which is collected through direct tax and indirect tax. Fiscal is concerned with fisc. Okay, the smaller version of fiscal is fisc, which is fiscal is derived from the word fisc, which is state treasury. State treasury is the money that the country possesses. Okay. Now fiscal policy relates to the budget, to the decision that determines whether the government will spend more or less than it receives. See, basically in simple language, if I say, this policy is concerned with analyzing how much money government is receiving and how much money government is spending. Receiving in the form of taxes and spending in the form of expenditure. This policy is concerned with two basic things: from the money received by the government and the spending of the government, how much they are receiving and how much they are spending. The budget should be balanced. Okay, if I am receiving 10 rupee and I am spending 15 rupee, so it's a deficit. And I am receiving 20, I am spending 50, then it's a okay somewhat, we can say. Expenditure should be always less as compared to income. Okay, so government tries to make a balance between taxes as well as expenditure, earnings as well as expenditure. So this is the condition basically that analyzes how much money should be spent. See, until Great Britain's unemployment crisis, there was a crisis in Britain in 1920, and there was a Great Depression. okay, of 1930. It was generally held that the appropriate fiscal policy for the government was to maintain a balance. It should not taking place like if like there is a high rise in price rise. Okay, there is a product's price is increasing very drastically. Earlier it was 10 rupee and now it is 100 rupee. So what will happen? People will be not able to purchase. And what will happen? The demand of that particular product is very high, supply is very less, pricing is very high. So there is an imbalance. So there should be balance between pricing, demand, supply, everything should be balanced in an economy. What the economy says, that should be balance between demand, supply and price. Three factors are there, na? Price of the product, demand of the product, supply of the product. Fiscal policy, let's focus on the meaning. Fiscal policy is the means by which government adjusts its spending level. Okay, how much we need to spend, government analyzes. Okay, and the tax rates to monitor and influence a nation's economy. It depends upon the country how much they are earning through taxes and how much they are spending on development of the economy, infrastructure, other facilities they are giving to the people of the country, because ultimately they are collecting the money or the revenue from the public, so they need to provide them with all the service, all the benefits. Okay, it is the sister strategy of monetary policy I have told you earlier also, through which central bank influences a nation. It is given by the central bank of a country, that's Reserve Bank of India. Okay, through the fiscal policy the government of country controls the flow of tax revenue and public expenditure. What is the revenue of the government and what is the expenditure of the government? Through fiscal policy, government analyzes to navigate the economy. If the government receives more than the revenue it spends, it runs surplus. Okay, if I have receiving 20 rupee and I'm spending 15 rupee, then it's a good condition. Whereas if I'm receiving 20 rupee and I'm spending 30 rupee, it's a not a good condition. Surplus is a good, deficit is not good. So government need to analyze the budget should not go in a deficit. If it's going in a deficit, then it's a dangerous condition for an economy. Okay, while if it spends more than the tax or not tax received, it runs a deficit to meet the additional expenditure. The government needs to borrow domestically from overseas. Alternatively, the government may also choose to draw upon its foreign exchange or print additional money. What will happen if they will not having money? They need to borrow from, they will be borrowing from other foreign institute. Okay, like World Bank. World Bank grants the loan to the other countries if any financial crisis is going on in the country. Okay, now example, let's focus on the example. During an economic downturn, the government may decide to open up its coffers to spend more on building projects. See what will happen if the government is having a good source of revenue, if government is collecting good source of taxes, they are going to spend on building projects, welfare schemes, providing business incentives. The aim is to help to make more production money available to the people, free up some cash with the people so that they can spend it elsewhere, and encourage business to make investment. At the same time, government may also decide to tax business and people a little less, okay, thereby earning lesser revenue itself. See, if government is having a good source of revenue or taxes, they are going to spend on infrastructure, developing the economy, and thus that economy, if our government is establishing our industry or infrastructure, they are generating employability, people will be having job. Okay, people will be having revenue, people will be having revenue, so they, what will happen, they are going to save, then they are going to invest, and that will generate capital formation. There will be contribution towards GDP, GNP, per capita income. So what is this? This is the growth of an economy. Okay, now definition: the conscious attempt of government to achieve certain macro goals or policy by altering the volume and pattern of its revenue. Okay, it's very necessary for government to change repo rate, reverse repo rate, fiscal policy, monetary policy on the regular basis, seeing the external forces and factors, seeing what is the condition of the economy, it's an inflation, deflation, they analyze all the factors and forces. After that they change reverse repo rate, they change CRR, SLR, everything. Okay, See, the conscious attempt of government to achieve certain macro goals. Some macro goals are there. I have told you, providing employability, eradicating poverty, capital formation, infrastructure development, removing regional disparity, imbalance between income and wealth. Okay, policy by altering the volume and pattern of its revenue, changing the pattern of its revenue, where they need to spend. Okay, it's very important. If they are not receiving good source of revenue, then they will reduce the spending. It depends. If you're receiving a good, you're going to spend a good. But if you're not receiving, then you're not going to develop the infrastructure. Okay, and expenditure and balance between them. There should be a balance between income and expenditure. Okay. Now, fiscal policy is concerned with basically two things. I've told you earlier also, income and expenditure. Income and expenditure. Income, revenue. The revenue is collected by the people through the form of taxation, direct tax, indirect tax. Expenditure, where they are going to spend the money received through taxation, that's government spending. Now, what are the object of fiscal policy? Very, very important point. Economic stability. Economic stability is concerned with that my economy should be stable. There should be no less fluctuations in an economy. All of a sudden, my economy is at the peak, inflation is very high, then all of a sudden deflation. If this situation is going to happen in any economy, what will happen? There will be no systematic functioning of the economy. Okay, there will be no jobs. There will be poverty, no capital formation, no investment, low GDP, GNP, per capita income. That's why government makes policy, implements policy, so that the economy is stable. Okay, there are less fluctuations in economy. Reduces deficit balance of payment. Very important point. There should be a reduction of deficit balance of payment. My expenditure should not be high than income. Okay, my income should be high than expenditure. Very important. Most of the time, most of the country, if they become insolvent, like Greece, because their spendings were very high, the expenditures were very high, whereas the income were less. They were taking loans from World Bank and other countries. They were not able to repay because there was no economy scenario going good. There were no jobs, there were no income earning from different sectors, infrastructure, industrial sector, agriculture sector, or different sector. What happened? There was no capital formation, there was no GDP, GNP, per capita income. So what happened? There was no source of income. The income was not there and the expenditures were very high. So that's why every country tries to reduce deficit balance of payment. It's a worst condition for any economy. Most of the underdeveloped countries are dealing with deficit balance of payment. You take Pakistan, okay, you take Afghanistan, you take Syria, all of these countries, okay. Economic growth, there should be a growth in economy. Growth of economy refers to there should be the development in infrastructure. All the facilities should be there. There should be increase in GDP, GNP, per capita income. Okay, capital formation should be there. There should be huge investment in the form of share market, investment in the form of money market, capital market. What happens if you are investing in this different market? There is a return, and return will generate more income. Okay, employment generation, yes, this is very important because government spends the money in different sector. If they have a revenue, infrastructure, medical facility, that's generating employability. People will be having jobs, and thus they will be contributing towards GDP, GNP, per capita income. Effective mobilization of resources. The mobilization of resources takes place effectively through the policy formulation. Objective full employment. Okay, it means that manpower is ready to work at the prevailing wage rate without any disputes. This issue is a very big issue, employment. Most of the underdeveloped countries are facing the problem of employment. People are not having job in spite of they are working for the job. Okay, so the very, very important object of fiscal policy is to generate employability. People should have work. If they are having work, there is the eradication of poverty. There is a generating of revenue and capital formation contributing towards GDP, GNP, per capita income. Reduction in economic inequality. The prominent aim of fiscal policy is to remove economic inequality so that the burden of such taxes generally fall on rich people. Very important. What happens? See, basically our policy is like that, which just basically supports rich people rather than the poor people. So the fiscal policy should concerned with analyzing or putting the burden on rich people more. That's why the tax system of a country, like if I talk about partnership firm or companies, the tax rate is just high as compared to an individual. If the income group is less than 2,50,000, there is no tax. So basically the poor people are not burdened with the tax in our country, whereas the rich people are burdened with a high rate of tax. Now price stability, very important, very important. The price of the product should be stable. They should be not fluctuating on the regular basis. When prices rise, there is an inflation. I've told you, where there is a rise in the price of the product, there is inflation. Okay. Its aim is to decrease the demand and expenditure, and the tax rate increases. Extra purchasing power of people goes to the hand of general public, and demand decreases because of the excess supply. Prices automatically go down because of fear of stock. This is all about what is the price. If the price is very high, what will happen? People are spending more, so the government need to regulate the money. Government need to control. Money should be in the balance. So what happens? The government controls it by selling of bonds, so that public can purchase bonds from the government, and in return they give them interest, and indirectly they receive money from the public. Economic development, there should be development of economy. To achieve economic development of a country, fiscal policy act as a source of capital formation. Capital formation, what is capital formation? Basically, capital formation, if there is income, there is savings, there is investment in capital market, share market, money market, and there is a return in the form of dividend, interest, and my money is getting increased by investing in different market. So that's capital formation. Capital is generated, capital is increasing, my money is increasing. Okay. Capital formation, because capital formation is increased, production and employment also increase. Now capital formation, development of effective mobilization of resources, increasing of national income, I've told you earlier, development of infrastructure, reducing the deficit in the balance of payment, balanced regional development. Okay. Now tools, what are the tools of fiscal policy? Public revenue, public expenditure. Okay, public revenue is the income received through taxes. Public expenditure is the spending of the government. Revenue received, capital received, tax in the form of direct tax, indirect tax. Public expenditure is concerned with revenue expenditure and capital expenditure. Let us study in depth. Okay. Now budget. First point is budget. Budget, what is budget? Budget is a financial statement. Okay. Budget is an annual financial statement which is presented by the government of India. It's presented annually. Okay. There are two things in a budget. There are two things in a budget. That's receipt and expenditure. Okay. How much there is a receipt, how much they are receiving, and how much they need to spend. Okay. Receipt in the form of taxes. Okay. And spending in the form of infrastructure. The government spends on infrastructure like development of roads, bridges, education facility, medical facility. Okay. This all things are concerned with basically spending of the government, and this is concerned with the earning of the government. So if the government is receiving 100 rupees and they are spending 80 rupees, then it's a balance. Somewhat we can say it's a surplus, not balance, it's a surplus. And if they are receiving 100 rupees and they are spending 120 rupees, that's a deficit. So government needs to analyze that my budget should not be deficit. My expenditure should not exceed the income. My income should be more than expenditure. Okay. Deficit is concerned with my income is less, my expenditure is more. Surplus is concerned with my income is more, my expenditure is less. And balance is 100. Receipt is 100, expenditure is 100. Okay. Now taxes, there are two types of taxes basically: direct tax, indirect tax. Direct tax, tax which is collected from the people directly, and the most important source of direct tax is income tax. Okay. Wealth tax, gift tax, they are also direct source of taxes. Okay. Indirect tax, VAT, value added tax, service tax, octroi tax, duties. Okay. Now taxes are the main source of the revenue of government. Okay. How the government earns? Through taxes. Without taxes the government won't have any money. Okay. The spending of the government depends totally upon taxes. Government levies both direct and indirect tax in India. Both the taxes, whether it's a direct tax, whether it's an indirect tax, both taxes are very important source of revenue in India. Direct tax are those which are directly paid by the SSC to the government. Income tax, wealth tax. Indirect tax, see, in direct tax, you need to remember direct tax are two types: income tax, wealth tax. Indirect tax are VAT, you need custom duty, excise. Okay. Now direct tax are progressive in nature. Okay. Indirect tax are not progressive. Progressive, basically what is progressive? See, indirect tax, I am going to a hotel. Okay. There is a certain amount of money I need to pay. That's a tax. I can't levy on other person. I have to pay only. But direct tax, I can levy on other people, other person. Okay. These changes are from all segment of society at the same rate. The main object of taxation policy is mobilization of resources. The resources should be mobilized. Okay. To promote savings, savings should be there. That's why there are exemptions in different sections in income tax. Okay. If you are investing in agriculture, if you are purchasing government bonds, if you are investing in PPF, and different sections are there, there is an exemptions. Okay. That's why government supports saving, capital formation. They sell government bonds so that people purchase the bonds and they get an interest. Okay. To bring equality of income and wealth. Income and wealth should be equal. Taxation is complete. Now, in July 2017, there was an introduction of GST, Good Service Tax. Okay. CGST is Central Good Service Tax. IGST, Integrated Good Service Tax. SGST, State Good Service Tax. Okay. IGST, integrated, is a combination of both this. It's a central level, it's a state level. Okay. It relies on the central level of the country and it is on the state level. The taxes which should be paid to the state, and this is to the state country level. Okay. Central level. Now public expenditure. What is public expenditure? Expenditure is spending. Okay. Spending. Government spends on different sectors. They need to spend. If they don't spend, what will happen? The economy will be not growing. Public expenditure is spending made by the government of a country on collective needs and wants. Pensions, provision, infrastructure. Okay. See, this is the basically government's expenditure pro forma. Okay. First of all, let me give you some little bit briefing about public expenditure. Public expenditure influences the economic activity of a country very much. If they are spending a lot in different sectors, what will happen? The economy will be growing. If they are opening schools, if they are opening education sector, new hospitals, developing roads, bridges, everything they are doing, what will happen? The country will be developing. Like USA, China, these all countries have a good infrastructure because government spending is huge in this country. Okay. Public expenditure may be of two kinds: development and non-development. Expenditure on development activities require huge amount of capital. If they want to develop the economy, if they want to spend money on medical facility, education facility, infrastructure, building of roads, bridges, canals. So what is this? The amount of capital is huge in this activities. Okay, so much capital cannot be made available by private sector alone. It requires public expenditure. So public expenditure is collected through taxes. Okay, public expenditure may be made in many ways. Development of state enterprises, support to private sector, development of infrastructure, and social welfare. Welfare of the society. Okay, providing free education, providing free medical facility, providing the students with the free books. Okay, providing with the free food facilities. Okay. Revenue expenditure, capital expenditure. Revenue expenditure, payment of interest, payment of salary, pension, grants and subsidies, education and health service, defense service. Okay. Capital expenditure, construction of roads. Roads need to be constructed, bridges, building, purchase of land, machinery, investment in share, loans. Okay. Loans and payment to foreign country, repayment of loan. These are two types of expenditure basically the government has. Okay, revenue expenditure and capital expenditure. Public debt. What is public debt? Borrowing from central bank. Debt is the money which is borrowed from other like organization, because the government doesn't have the money and they need to develop the country, so they need to borrow money from outside sources. Okay, government needs lot of funds, okay, for economic development of the country. No government can mobilize so much of funds, making roads, bridges, they need crores, million of money, but government doesn't have such money. So they need to develop roads, they need to develop schools, medical facility. So what happens, they need to borrow debt, loan from different organizations. It is therefore become inevitable for the government to mobilize resources for economic development by restoring the public debt. Public debt is obtained by two kinds, internal debt and external debt. Okay, borrowing from central bank, Reserve Bank of India. Market borrowing, borrowing from market, borrowing from international organization, IMF, International Monetary Fund, World Bank. They grant loan to different countries. If any country is financially weak, if any country is not stable in economically, so this organization, IMF, International Monetary Fund and World Bank supports all the country. They are basically established in USA, okay, United States. Borrowing from public through treasury bill and government bonds. What happens if the government doesn't have money? They sell the government bonds and they indirectly get the money from the public and they give them the interest. Now, what is the importance of fiscal policy? Fiscal policy play a very important role in our country for stabilizing the economy, for generating employability, eradicating poverty, development of infrastructure, removing regional disparity, reducing the difference between income and wealth. Okay, in a country like India, fiscal policy play a key role in increasing the rate of capital formation both in public and private sector. Through taxation, the fiscal policy helps mobilize considerable amount of resources for financing in numerous projects. Through this policy, the government analyzes where we need to invest so that there is a capital formation, there is more jobs, there is less poverty, there is increase in GDP, GNP, per capita income. Fiscal policy also helps in stimulating or elevating saving rate. Through fiscal policy, people will be having job, there will be more savings, there will be more capital formation. And what's this? This is saving. If people are earning good, they will going to save it. If there is no job, how people are going to save? Okay, the fiscal policy gives adequate incentive to the private sector to expand its activity. Importance of fiscal policy: increase in the rate of savings and investment. Through fiscal policy, there is an increase in investments as well as saving, because there is more jobs, people are having good salary, so they are going to save the amount and they are going to invest in capital market, money market, okay, purchasing bonds, debentures, shares, Increase in capital formation, there is an increase in capital formation, I've told you earlier also. Reducing inflation, there will be reduction in the inflation. Reducing in the pricing, because there will be controlling how much money need to be floated through fiscal policy. Mobilization of resources will be mobilized through this policy. Reducing in government spending and no change in tax rate, there will be reduction in the government spending. They're going to analyze, we are not going to waste the money in different sector. The sector which is important, the sector which will generate employability, we are going to invest in that sector. To promote economic stability, there should be a stability in the economy. There should be no inflation, there should be no deflation. So if you like my video, do like, share and subscribe my YouTube channel. Thank you.